All right, let's get straight into it. We are doing a deep dive analysis on an IPO that has everyone talking. Haiwei Electronics, stock code 9609. My goal here is to cut right through the hype, look at the actual business, the numbers, the risks, and then give you a clear, actionable strategy. So, let's jump in.
Okay, the first thing you need to see is this number, 818. That's how many times the retail portion of this IPO was oversubscribed. Now that signals massive demand for sure, but it also begs the most important question we're going to answer today. Is all this hype justified, or is this just a classic trap for investors who get caught up in the excitement?
So let's start at the beginning. Section 1, the opportunity. Who is this company really, and why is everybody so interested in them right now?
To put it simply, Haiwei Electronics makes something called capacitor-based film. Just think of it as a really critical ingredient for pretty much the entire modern electrical world. Without this stuff, a lot of the high-tech gadgets and systems we depend on, they just wouldn't work.
And where does this film actually end up? Well, we're talking about the absolute heart of today's biggest growth sectors: new energy vehicles, solar and wind power, advanced industrial equipment. These are the markets that are literally building the future, and Haiwei is right there, a key supplier. This is the story that's getting everyone so excited.
Okay, so let's move into Section 2. A great story is one thing, but how does Haiwei actually make money from all this? We need to get inside their business model.
Let's get a little more technical for a second, just so you really get it. This capacitor-based film, it's not just some piece of plastic. It's a super specialized insulator. Its whole job, its critical purpose, is to manage high-power electricity inside things called film capacitors. And these capacitors are basically the gatekeepers of energy in everything from an electric car to a giant wind turbine.
So here's where they sit in the grand scheme of things. Haiwei buys the raw material, this special plastic, then they use their tech to manufacture the high-tech film. After that, they sell the film to companies that build the actual capacitors. And finally, those capacitors get sold to the end users, like, say, a car company that puts it inside the inverter of an electric vehicle. You see, Haiwei is that crucial link right in the middle of the chain.
So who's buying this stuff? Well, the prospectus drops some pretty big names. We're talking about direct sales to giants like BYD, a world leader in EVs, and major component makers like Xiamen Ferrotronic. I mean, when you have names like that on your customer list, it definitely gives you a whole lot of credibility. All right, now for the part where the rubber really meets the road. Section 3, the financial health check. A great story and big-name customers, that's all fantastic, but we have got to see if the numbers actually back it up.
And this is the key question for any of us, right? A strong business model is awesome, but does it translate into a strong business? Is this company financially sound? Let's dig into the data.
So let's start with cash flow. Back in 2022, it took Haiwei about 106 days, on average, to get paid by its customers after they made a sale. Okay? That's our starting point. Now look at this. Fast forward to the most recent data we have, and that number has exploded to almost 157 days. That's a 50% jump. Think about what that means. They're waiting an extra 2 months to get paid for work they've already done and delivered. That is a massive red flag for their cash flow.
And this table right here tells a really important story about their profits. Let's walk through it. First, look at that top line, raw material costs. It's jumped from 45% of revenue to over 70%. That means for every dollar they make, 70 cents is immediately going out the door just to buy their main ingredient. That's a huge squeeze. Now look at the direct result on the second line, gross profit margin. It has been absolutely crushed, falling from a healthy 45% all the way down to under 17%. Now there is one bit of good news here on the bottom, inventory turnover. They're selling their product faster, which is great. But honestly, that efficiency gain is being totally wiped out by the fact that their profit on each sale is collapsing. This is a very serious trend.
And those worrying financial trends, well, they lead us right into Section 4, decoding the critical risks. Every company has to tell you what could go wrong. And believe me, we need to listen very carefully. And they say it right here, plain as day, in their own prospectus. They're saying they are very dependent on their key people. If one of these top individuals leaves, it could have a material adverse effect on the whole business. Classic key person risk. And that's just one piece of the pie. The prospectus lays out several major risks. You've got that key personnel reliance we just talked about. You've also got a big one related to customer concentration. And then there's the raw material price volatility, which we just saw is already hammering their profits. It's a lot to consider. And let's put a hard number on that customer risk. In 2022, one single customer made up over 17% of their entire revenue. Now, if you lose a customer that big, that is a massive, massive blow to your business overnight.
Okay, we've looked at the business, the financials, the risks. But to make a smart decision, that's not enough. We have to move to Section 5 and understand the very specific dynamics of a Hong Kong IPO. It's a totally unique game, and it has its own set of unwritten rules.
And here's one of the most important concepts you need to get. It's an insider term called market cap management. You won't find it in a textbook. It's basically when the company or its backers take actions behind the scenes to support the stock's price right after it lists, to make sure it has a nice, stable, and hopefully rising debut. It's a huge factor in how these things trade.
Now let's put Haiwei in context with the other hot IPO happening at the same time, QuantGroup. That one was oversubscribed over 3,600 times. Insane! But the word on the street is that QuantGroup is so tightly controlled that retail investors like us will get practically zero shares. Haiwei, on the other hand, while still incredibly hot at 818x, is a different animal. There's a strong suspicion of that market cap management being in play, and crucially, its float, the number of shares available to trade, is bigger. That means it's actually possible for people to get a decent number of shares, which makes it a much more actionable opportunity.
So, all of that brings us here, to the final section, my subscription strategy. We're going to weigh the good versus the bad, the bull versus the bear, and lay out the final play based on everything we've just gone over.
So let's put it all on the scales. The bull case? It's pretty compelling. Haiwei is in the right markets, they have the right customers like BYD, and the demand for the stock is obviously off the charts. The bear case? Well, it's just as clear. The financials are showing some really worrying trends with cash and profits, and there are some real, significant risks to the underlying business.
So after weighing all of that, the business fundamentals, the financial red flags, and the market game, the strategy actually becomes surprisingly clear. The play here is to load the boat on Haiwei.
And here is exactly why. First, there's a strong belief that market makers are going to be there to support the price. Second, the float is deep enough that bigger players can actually get shares, which isn't the case with some of these other deals. Third, that 818 times oversubscription, that's not just hype, that is a powerful signal of real demand that can push the price higher. And finally, it's just a better bet for actually getting an allocation compared to those other hyper-subscribed deals. In the unique game of Hong Kong IPOs, this makes Haiwei a tactical play. It's a decision based not just on the company's long-term story, but on the structure of the market right now.